Hello and welcome to this video where we will be discussing selling put options in the stock market. In this video, we'll be discussing what put options are, how they work, and why selling them can be a profitable strategy for investors. When an investor sells a put option, they're essentially taking on the obligation to buy the underlying asset at the specified price if the buyer decides to exercise their option. In exchange for taking on this obligation, the seller of the put option receives a premium from the buyer. So why would an investor want to sell put options? First, it can be a great way to generate passive income. When an investor sells a put option, they receive a premium upfront and keep the premium as profit no matter what happens to the price of the stock. Second, selling put options can be a way to buy stocks at a discount. Let's say an investor wants to buy a particular stock, but they think the current price is too high. They can sell a put option with a strike price that's lower than the current price of the stock. If the stock price drops and the put option is exercised, the investor is obligated to buy the stock at the strike price. This can be a way to buy the stock at a discount. Third, selling put options can be a way to hedge against a decline in the market. If an investor is worried that the market is going to decline, they can sell put options on stocks they're interested in buying. If the market does decline and the put options are exercised, the investor will be obligated to buy the stocks at a lower price, which can help offset any losses from the overall decline in the market. So how do you sell put options? The first step is to choose an underlying stock or ETF you want to sell puts on. Note, this should be a stock that you wouldn't mind owning 100 shares of. Next, you'll need to choose a strike price and an expiration date for the option. The strike price should be a price at which you'd be comfortable buying the underlying asset if the option is exercised. The expiration date should be far enough in the future to give the underlying asset time to appreciate in value, but not so far in the future that the option becomes too expensive. Remember, each options contract represents 100 shares of the stock, so the obligation when selling a put is to buy 100 shares of the stock if the price drops below the strike price you choose to sell the put option at. Let's go through an example together. Let's say you're interested in buying shares of XYZ stock, which is currently trading at $50 per share. However, you think the stock might drop in price in the short term before rebounding. You could sell a put option with a strike price of $45 and an expiration date of 3 months from now. Let's say the premium you received for the option is $2 per share. If the stock price stays above $45, the option will expire worthless and you'll keep the $2 per share premium. This means you've generated income without having to buy the stock. If the stock price drops below $45 and the option is exercised, you'll be obligated to buy the stock at the $45 strike price. This means you'll effectively be buying the stock at a discount since the current market price is $50 per share. However, if the stock price continues to drop after you've bought it, you could end up losing money on the trade. The $2 per share premium totals 4% return on your initial investment of buying 100 shares at $50 per share. At this rate, we can expect about a 16% annualized return if we continue this strategy throughout the year. So in this example, you're selling a put option to generate income and potentially acquire XYZ stock at a discount. At the same time, you're also taking on the risk of having to buy the stock at the strike price if the stock price falls below that level. It's important to carefully consider the risks and rewards of selling put options before making any trades. What are the risks of selling put options? First, if the underlying asset drops significantly in price and the put option is exercised, the seller will be obligated to buy the asset at the specified price, which could result in a significant loss. Additionally, if the seller doesn't have the funds to buy the asset, they could be forced to sell other assets to cover the obligation. It's important for investors to do their research and understand the risks before selling put options. They should also have a solid understanding of the underlying asset they're selling options on and be comfortable with the possibility of buying the asset at the specified price. In conclusion, selling put options can be a profitable strategy for investors looking to generate income, buy stocks at a discount, or hedge against a decline in the market. However, it's important to understand the risks involved and do thorough research before getting started. I hope you found this video helpful in understanding the basics of selling put options. Let me know in the comments if you have any questions or if you've had experience selling put options yourself. Thanks for watching, and don't forget to like the video and subscribe for more investing videos.